collaborative community. Got it? So our vision is to build a collaborative community of Nigerians in diaspora, develop members to become global leaders. And our purpose is to empower Nigerian professionals in diaspora, and of course our allies, to evolve into exceptional leaders through the promotion of self-awareness and personal growth. We provide opportunities to enrich our members' personal experience and expand their professional network while unlocking the uncharted potential of our Nigerian identity. All underscored by our unwavering commitment to serving our community. I remember when I moved to Boston in 2018, I was looking for every opportunity to network. I met Kay, introduced me to NPG, and the rest is history. So I was able to build my connection within the Boston area in a short period of time, which has also impacted me with all the resources I needed, for someone that just moved to the city. And today my professional network has grown. And yeah, I want to say a special thank you to every one of you for joining us again, and most especially to our guest speakers for making themselves available for one of our flagship events. We had a similar event last year. So every time of this year, we're going to be having this tax event where you can come up with your questions and ask our tax professionals, and they'll be happy to answer your questions. If you like to learn more about NPG, please visit our website at www.nigerianprogroup.org. And if you would like to be an official member of NPG, you can reach out to myself, or you can go to the website, check it out. And you can also follow us on all our social media. We're on Facebook, LinkedIn, Instagram, and WhatsApp. Yep. So I'm going to run through the agenda really quick. First of all, I'm going to be introducing our keynote speaker, Aaron. Aaron is a senior tax associate at KPMG. He's been doing this for 6 years, and then he'll be giving us opening remarks today. And then I'll pass it on to Oreoluwa after that for the panel discussion, where we're going to have Mr. Oluwole Babalola and Mrs. Taiwo Agbaje, who will be answering our questions today. And then after that, which is going to be for roughly about 30 minutes, and then we'll have a Q&A session where we open up the floor for the rest of the audience to ask the questions. And to ask your questions, you put it in the chat box, or you can use the reaction button in Zoom to raise your hands if you prefer to ask your questions verbally. Yeah, and then after that, so Oreoluwa and Tony will be facilitating the Q&A session. And then Mr. Tony is going to give us the closing remark. And I hope we all have, I know I'm going to have a wonderful event today, and hopefully all my tax questions will be answered. So feel free, post your questions. This is going to be a really informative session for us all. So on that note, I'm going to pass it on to Aaron.
Good afternoon, good morning. Thank you so much for having me. My name is Aaron Mundell, and I'm a tax professional working for KPMG. I work in the partnership and individual taxes. And today I'm going to give some opening remarks about some of the trends and tax regulations that we see here in the US. So in terms of current trends, right now, everything is very big on renewable energy. So we're seeing a lot of tax credits around, electrical vehicle, solar energy. So for homeowners who are buying solar panels, we're seeing a lot of tax credits, and we're also seeing a lot of credits in the employment space. So there's a lot of work opportunity credits for people that are hiring certain folks, and some of the tax challenges that are going to be happening soon is because we're entering an election year. So whenever this happens, we see a lot of changes in terms of laws and regulations, and the political process has a big impact on taxes. So definitely encourage people to stay up to date and ask us questions when it comes to different tax regulations that are happening.
Thank you, Aaron.
Sure.
And then we're going to move to the next item on the agenda. So, Oreoluwa, let's open up to the speakers and let's dive in right away.
Hello, everyone. Welcome again to this webinar on tax, a tool for wealth management. And for this webinar, we have two seasoned professionals on the call with us. We have Mrs. Taiwo Agbaje and we have Mr. Oluwole Babalola joining us on the call today. And I'm just going to go through a condensed version of the professional achievements of our speakers. And of course, you're very much welcome to use the reaction button to clap, and hail them for their expertise. Okay, so let's dive right in. We have Mrs. Taiwo Agbaje. Mrs. Taiwo Agbaje is the founder of TRA CPA LLC in Austin, Texas. And she's a licensed CPA in Texas and Indiana. And not just that, she's had 18 plus years of experience in accounting and finance. She began her career in Nigeria, working in the banking sector, and proceeded to work with multinational companies in the United States of America. She's a member of many professional organizations, including the American Institute of Certified Public Accountants, the Texas CPA Society, and the National Association of Tax Professionals. She chairs the Professional and Technical Committee of the Institute of Chartered Accountants of Nigeria, US chapter. Beyond her professional achievements, she's mentored young accounting professionals and continues to share knowledge, paving the way for others. She's married with 3 children. Now you can use the reaction button. Now we go to Mr. Oluwole Babalola. He is the owner of WT Babs Tax Accounting Services Incorporation, which specializes in various auditing, accounting, and tax services for individuals and small businesses with over 20 years of experience. Mr. Babalola began his career in the financial services industry in 2001 with State Street Corporation, and then moved to Deloitte and Touch LLP as a senior auditor, and again at State Street Corporation as a lead financial officer until April 2021. He received his designation as CPA in 2004 and have been helping small businesses with tax advice, preparation, bookkeeping, payroll, auditing, and financial statements compilations since then. Mr. Babalola now manages the accounting firm that focuses on helping small businesses achieve their financial goal. Thank you very much, Mr. Wole Babalola and Mrs. Taiwo Agbaje for joining us on this call. Now let's get right into it. For our panelists, we have some questions that we've prepared on hand that we would like to ask you. And I'll be directing my very first question to Mr. Babalola. And the first question goes this way. What are some common tax deductions individuals can take advantage of? As you know, we are a professional group that is comprised of people across different sectors, different walks of life. And these are some of the concerns that some of us have, especially within this tax filing season, and the tax deductions that we can take advantage of.
Thank you very much. And I want to say, can everybody hear me?
Yes, we can hear you.
All right. So thank you very much for inviting me to this program to show some of my expertise and my knowledge of taxes and how it can affect individual. I'm so honored to be invited. Thank you very much to the group. When we talk about deductions for individual, basically the way the IRS put this together for individuals, I believe most of us know, is that we have there are 2 distinct areas of deduction. One is standard deduction, and the other one is itemized deduction. And the standard deduction is basically for, income earner that are not that high and they are able to, or they don't have a lot of expenses to claim. So they go with the standard deduction, and that will help them to be able to, reduce their taxes based on where their income lies. But the other one, which is more in terms of itemized deduction, is where it's a little bit where I'm going to be focusing some of the discussion into. Basically, if you itemize, you have the options of deducting most of the expenses you may have in terms of your daily living. Basically, the like a mortgage interest, it's one area that most homeowners are usually advantages of. And we also have other things like if you are an individual and you are into maybe small businesses, you can deduct business use of your car, you can deduct business use of your home. You could put more away in IRA, and that can also be a deduction on your taxes. The other thing is health savings account. You know, most of the people that works in a company that offers HSA, you know, that is an opportunity for you to reduce your taxes as well there. If you are going to school and you have tuitions, you can reduce your taxes by, claiming the interest you pay on your student loan. Also, if you have children in college and you're paying tuition on them, there are a lot of things that you can use in that area as well. Also, if you're a teacher, you can deduct an approximate amount of your expenses as a teacher. It's called educator's deduction. You can deduct that as well. So all this is some of the things that you can deduct. There are so many of them. The other thing that comes to mind is if you itemize, of course, and you have tax, your state taxes that you paid, you can deduct them in your itemization. You can deduct mortgage interest, donation to charity. You can deduct that. And then there are some other things like gambling losses for those that gamble. You can deduct that as well, up to the amount of gains of winnings that you have during that year. So those are some of the things that you can deduct, and I'm sure by the time we get to question and answer from the audience, we may be able to add more to that. But there are a lot of it. And another one that I just remember now is the medical expenses that is over 7.5% of your income, of your adjusted gross income. Then you can deduct that as well. So those add up, can really reduce your taxable income, and you will be able to lower your taxes from there.
Thank you very much,
Thank you.
Mr. Babalola. From that, I hear that mostly the deductions we can benefit from are usually from the itemized section, which includes daily living, mortgages. And something that, sparked my interest was when you mentioned gambling losses. So we can deduct, for the gamblers in the room, here you have it. You can deduct your gambling losses / gains for the year. Thank you so much for that, Mr. Babalola. And now we're going to move to Mrs. Agbaje. Mrs. Agbaje, we're going to be looking at tax implications, and we would like to ask you that, are there any tax implications that you would advise us to consider when you want to plan for estate or inheritance around any of the subject matters? Any tax implications we should be aware of?
Yeah, absolutely. Thank you for that beautiful question. But before I begin, I would like to thank the organizers of this event for inviting me and for giving me the opportunity to speak to your audience. And so going back to the question, yes, definitely. So estate planning is something that everyone should be kind of aware of or should be knowledgeable about. That's because death is inevitable and eventually we will all pass. But there are certain tax considerations that you need to be aware of before you even proceed to getting an estate plan or to moving forward with that planning strategy. And the thing is that you have to understand that, particularly for estate planning, the goal is to minimize the tax implication and liability when someone passes away, such that their dependents or their survivors are able to easily transfer, the assets are easily transferable to those dependents that they have left behind. And so the goal here is to minimize overall tax liability on the estate when those assets passes to their survivors. And now, so particularly when it comes to estate planning, what you need to understand is that when someone passes away, in the United States, if an individual doesn't have an estate or doesn't have a trust, the distribution of the asset of that individual is done using the state law. So that's when you hear people talk about going through probate system and all of that. So if you don't have an estate, if you don't have a will or a trust that could be utilized to distribute your properties, it becomes something that the state will have to take over and do on your behalf. And so that's one of the reasons why, particularly for us, as even immigrants or anywhere you are, to have a plan for when you pass away so that your family, your loved ones are not going to go through the stress of going through the probate system. Now, when it comes to the tax implication, once you pass away, when an individual passes away, what happens is that if the estate of that individual exceeds $250,000, they are going to have to pay an estate and trust tax return, which is a Form 1041. So that form is where the income and the expenses of everything that has to do with the estate of that individual is reported to the government, and it's also taxed at, the tax rate is between 34% to 40%. So depending on where the value of the assets lies, they're going to be taxed based on that value. Now, another key consideration, which is very, very key, I get this often, is that when is the best time to transfer your assets to your heirs, to your children, or to your family? And the best time is actually after an individual passes away. And I'll explain why. So generally, assets given away during the life of an individual retains the taxpayer's basis. When we talk about basis, we are talking about the cost to that individual for that particular property. So when you gift or when you pass a property over to your children or to your family, when you're alive, they are taking over the basis of that same property. Versus when you wait till when you pass away before that asset transfers to them, they are going to take up a step-up basis. The step-up basis is the basis as at the day of death. So let me put this in perspective. Let's say someone has an asset, a property that owns that is valued at $100,000. Sorry, at $100,000 for simplicity, for a simple calculation, right? So let's say they have a property that was valued at $100,000, and they purchased that property at $20,000 10, 20 years ago. If they give that property to one of their kids while they are alive, the child is going to take up the basis, which is $20,000. But if they do that transfer after they have passed away, the property value will be based, the basis will be based on the date of death. So what it does is that it significantly minimizes capital gains tax. So I get this question a lot. So for people that have parents that are trying to pass over properties to them, if it's okay, you can consult with someone and let them know, can do the calculation based upon the benefits to you if those properties were transferred after your parent or your whoever is transferring that property as part versus them transferring those properties to you when you are alive. So that's the most important, and this applies to not just properties, it also applies to a lot of other investments as well. It's a lot better to transfer properties when that individual has passed, so that the step-up basis kicks in and it reduces the capital gains tax in that transfer.
Thank you so much, Mrs. Agbade, for that elucidation. And when it is the right time, the best time to transfer our inheritance to our beneficiaries, saying that it's right after the passing away of the deceased, to take advantage of the step-up basis and to minimize capital gains tax and inheritance tax to be paid. And also thank you again for pointing out the fact that it is very important as people to plan ahead, even for after our death, so as to avoid the applicable state laws across different states, the government sharing our properties in the way that the owner of the property might not even wish to, but just because there's no will, there's no estate trust, and then the government having to step in. Thank you so much again for reminding us of that, basic and salient fact, even as we plan our lives. Thank you so much, Mrs. Agbade, for that. Mr. Babalola, we're coming back to you. And I think this is a topic that everybody is very much interested in, because we know that as young people, a lot of us are planning on how we want to get into the homeowners league, through mortgage, outright sale of apartments, of homes, of condos, depending on whatever city or state we're in. And Mr. Bala, we would like to ask you, how can we prospective homeowners and current homeowners leverage tax benefits to reduce our tax burdens?
All right. Thank you very much. The homeowner, prospective homeowner or current homeowner can, have, like I said earlier in the first question, like there's the first thing that I can mention is the mortgage interest, right? If you're primary residence and you are living in there, you have mortgage interest. You can itemize that mortgage interest. That can really help you. I've seen that in most cases, in most tax returns of homeowners, that is one of the biggest deductions that they have. The mortgage interest, especially with the interest rate right now. Interests are high and you're paying a lot of money in interest. So you can take advantages of that in your tax return to reduce your burden there. That's one thing. For the prospective homeowner, first-time homeowner credit is available. You can get that as well if it's your first-time homeowner, or you can actually go to these banks and you can get a lot of rebates on what you're going to be paying in terms of your credit and everything like that to reduce your burden in the home ownership cost. The other thing that I have seen is the rental property. I would like to go to that area as well. A lot of people going into rental properties because they hearing that, oh yes, I'm going to be able to reduce my taxes because if I have a home, I can rent it out. But the thing about that is that I just want to put a little bit of caution in there that, you may have a rental properties, but if you are not a real estate professional, it's not really going to help you that much because you cannot really claim more than what you have got in the rental income. Basically, there's a limitation of how much losses you can claim. And so if your expectation is to be able to reduce your tax because you have a rental property, that may not happen because you will be limited in the amount of the losses that you can claim in a particular year. Although you can carry them forward, and carry the losses forward to the future years when you will have rental income and will not pay taxes on them. That's the only good thing about it. And apart from that too, you will be able to have a capital base, is an asset, right? So if you keep the asset, you'll be able to build your wealth through that. That's one way to build wealth. You have the asset, you keep the asset keep growing, and then the valuation is keep growing. And at some point when you sell it, you will only be paying capital gain tax, which is less than the rate is less than the regular tax rate. So that's another way to look at it and say where you can benefit from it. But in terms of homeownership, the regular homeownership, the only thing you can claim is the taxes, the interest in your itemization, and maybe if you pay points on the mortgages too, you can claim that as well. Those are the areas that I've seen that owners benefit from having a mortgage. Apart from that, really, it's just a part of itemization deduction.
Thank you so much, Mr. Bala, for that understanding. I'm sure that some of our guests in the house would have questions around mortgages and car loans and all of that. Please, if you have questions, you can use the chat box or you can write them down. And then at the end of the panelist questions and answers, we can then come to you and then have you ask your questions directly to our panelists. Thank you very much. Mrs. Agbaje, I'm coming back to you. And there's something that we would want to ask you because as you know, again, we're a young professional association. We have people who are just starting families, people who just started their families, who are about to start their families. And we want to ask questions around tax saving opportunities for families, you know, looking at child tax credit, adoption tax credit, things around, you know, building a young family and, you know, having some method, some means to also, you know, benefit from being a young family when it comes to tax and tax savings opportunities.
Yeah, thank you. That's a good question. So for those that have children, I would start from the credit first. The credits are different from the deductions, and those are usually a dollar for dollar tax savings, tax deduction. So for the credit, the child tax credit is available for individuals that have kids. Currently, it's $2,000 for each child that you own, and you can claim up to 4 or 5 children. And it also has its limitation. The refundable portion of that credit is $1,400 right now. There's a bill in the Congress that is going through approval. I think it's at the Senate right now. They're proposing to increase that refundable part of that credit. So, but what the credit does is that it gives families that have kids some money back at the end of the year when they are filing their taxes. So that's available for almost every taxpayer. The other one is adoption credit, which is for those that have adopted kids during the year. But beyond the credits, there are also other avenues by which a family could save on taxes using their children or their child. The first one I want to mention is for those that have kids that are still young, you could look into options of having a 529 account. 529 education savings accounts are usually state-owned and state-run programs where your state, some states could give credits. Some states usually give deductions. I know for a state like Indiana gives a credit of $1,500 for each year, up to a maximum of $1,500, depending on how much you contributed. So that's another thing. And the reason why I like 529 is that it also helps parents to invest into their kids' education, and they also get to take a tax benefit. But the consideration for that is you have to also understand it's not a federal program. And so what I mean by it's not a federal program is you don't get a tax savings on the federal level when you file your taxes. It's the benefit gets to you on the state level on your state tax return. So that's one. And then for 529, withdrawal from 529 has some strict rules that you need to also be aware of. But in terms of at least saving on taxes, you can explore 529 savings to save on state income taxes. Another aspect of that I wanted to talk about is those that have kids in colleges. If you have children in colleges, you can still claim, if you're paying for their tuition and you're responsible for their education, you can claim the American Opportunity Tax Credit for your kids that are still in the first 4 years of post-secondary education. That's also available for parents to claim. Although there are limitations to this, to the credit as well, but definitely it's available for people. Then for those that have businesses, I always want to mention this because I work with a lot of business owners. For those that have businesses, one way by which they can also utilize tax savings strategies and planning to help their children is to also look at opportunities to hire their kids in their business. So if you have businesses and you are your business is profitable and you have kids that are above the ages of maybe 8 and above, and you know they can do certain tasks within your business, you can employ them on the business so that they get paid and you get the deduction on the business side, and then you can pay those kids for what they're doing for you. That way you're helping them build financial independence. You're also helping them grow their investment, because most often than not, those monies are used to invest in Roth IRAs and other avenues for investment. But the overall goal is that you're starting those kids up financially at an early age, and they're also able to be independent and be able to continue to grow and be investment savvy before they get to 18 and all of that. So that's another benefit that I see that you can take advantage of for those that have kids. And of course, all of these considerations, all of these things are things that you still have to discuss with your tax professional. It isn't a cookie cutter approach, so you don't take it up and run with it. You still have to consult with a professional that can, really guide you through, particularly for the hiring of your child, the 529 strategy. There are things you can look up to or look up consulting with someone that can help you really set those up appropriately.
Thank you very much, Mrs. Agbaje. To the fathers and the mothers in the house, you've heard it. You can take advantage of child tax credit during this current tax year. As long as your children are also, if you have small businesses, as long as your children are above 8, you can hire them to run errands, bring coffee, and all of that in your business, and also claim child tax credit. Thank you so much for that, Mrs. Agbaje. Let me just piggyback on what you said, because I know that in our professional group, a couple of us had children as early as January. Multiple children have entered our group as early as January. And I just want to confirm that on behalf of those people who just had children like a couple of weeks back, to say, would these new babies also be eligible for child tax credit before the end of the filing in April? Or they have to wait to the next year to claim child tax credits?
Sorry, I think I lost you a little bit, but if I understood it correctly, you said the kids that were born in January of this year, are they able to take advantage of? No. So for those that are born in January of this year, they are going to get the credit when they file their taxes next year. So the credit is only available within the year that the child is born. Any child that is born, even if the child was born on the 31st of December of 2023, they get that credit. The child must be born within that year.
Wonderful. Thank you so much for clarifying that, Mrs. Agbaje. While we allow our panelists to catch their breath, I have one question that I'm going to direct to Aaron. Aaron, are you still with us?
Yes, still here. Yeah.
I have a question from somebody that is directly to you, and I just want to give this to you. It says, question for Aaron. What's the benefit of TVs and solar systems compared to replacement cost of the panels after the useful life? So it says, what are the benefits of TVs and solar systems compared to replacement cost of the panels after useful life?
It really varies on which company that you're dealing with, but I can give you more of a general answer in terms of the tax credits and incentives that are encouraged for people who want to participate in aspects that are environmental friendly. So a lot of the governments and a lot of the cities are highly interested in saving the environment. You hear a lot of going green because it's an initiative that's going to help, the world, the planet. So there's a lot of tax incentives that you can get, and it varies by state. It also varies by, the company that actually it varies by on the federal level and also on the state level. So as we mentioned earlier, taxes are, applied from a federal level and a state level. So depending on where you live, you're going to have different incentives. But here in Massachusetts, we do have some tax incentives for people who have solar panels for homeowners. As we mentioned, that can be another deduction that you can get if you're able to itemize.
Thank you so much, Aaron. So if you have EVs, if you have solar system for your house, or you have EVs for your vehicles and all of that, please reach out to Aaron again to find out more ways you can benefit when it comes to tax for this current tax years. Thank you so much for that, Aaron.
Okay.
Back to our panelists, back to Mr. Agbaje and Mr. Babalola. I just have a couple of more questions for you, and then we're going to open the floor to our audience to direct their questions to either yourself, to either Aaron, to either Mr. Babalola or Mrs. Agbaje. And I'm going to come back to you, Mr. Babalola, just before we go to the Q&A session from the rest of the group. And I want to talk about employer and employer-sponsored retirement plans. Like we said, a couple of us were divided into two buckets, the employees and the business owners. So this question is from the employee associations. So we're asking, for those of us who have employment, who are employed by different organizations, how can we as individuals reduce our taxable income through pre-tax contributions to our employer-sponsored retirement plans?
Thank you very much for that. Basically, employer that offers those contributions like 401k, 403b, and so on, it's really to benefit you as a person, as an employee, especially if they are matching it. What I would say is that, well, the government have their limits and amounts and stuff. I will go into that in a little bit, but I would start from the side of the employer, right? If an employer offer 401k, for example, and they said, okay, we're going to match 6%. So I will encourage you as an employee to take advantages of that, because what that means is that if you put 6% of your income into that contribution, the employer would add additional 6%. That means you're saving 12% for yourself for your retirement, which is not going to be taxable because it's pre-tax. And basically, like the state of Massachusetts, you have up to $2,000 to claim for things like that. But in the federal level, they actually take that amount, from your income, and before it is taxed. So in other words, you are not paying taxes on it. And the employer add additional to that, which you're not paying taxes on, and it will be waiting for you in the future when you retire. And in terms of the numbers and the limit, for example, with the 401k, you can contribute up to $22,500 in 2023, or if you get to the age of where you can do you can cash up to $30,000. That means you can save a lot of money and reduce your taxes from $22,500 not being taxed if you are a high earner. And if you are not even a high earner, you can take that advantage of free money from your employer that's giving you 6% or some 5%, some 8%. I've seen up to 8% before, and taking that advantage and contributing to it, not only that you're saving for yourself, you are also getting free money from an employer that is not taxable. And basically that will help you if you leave that money in there for the future. The other thing I will talk briefly about this contribution is that it's not expected that you will take it out as long as you're still working for that employer. You can roll it over. You can roll it to another tax advantage investment or anything like that. But if you take cash out, you will be penalized, and you pay 10% penalty on it, and that will not be, you look good in your tax return because you will have to pay those taxes back. But in effect, to be effective, you should leave it in there to continue to grow and use free money from your employer to build up your retirement account. That is very, very efficient, and it will reduce your taxes as well. One other advantages of that is, like I said, you can take it out, but some employers do allow you to take a loan out of it, and they will be paying back the loan from your paycheck. So that helps you. Maybe you want to buy a first home. You can take, some money out of it and put it in your home, and they'll be taking it back little by little from your paycheck. It helps you to have your down payment and all that kind of stuff that you need. Or if you want to, pay for your children's college, you can take it out, and there's an exception. That they will allow you to take out that money and use it to pay for colleges and without being penalized. So those are the areas where you're not going to pay. There's a lot of list of exceptions when you can take it out. But apart from that, it's usually not advisable because it's for your retirement. But the most important thing is that you are saving taxes and you are reducing your burden from both the federal and the state level.
Thank you so much, Mr. Babalola, for that. And our final question for this segment is going to be directed at Mrs. Agbaje, and then we're going to go into the Q&A from our viewers and our participants. Mrs. Agbaje, we want to direct these questions, now to the second side of the membership of the MPG, which is the business owners. And we want to ask you to say, what are the ways, the options that are available to small business owners in our group? How are they able to save, when it comes to tax? What options are available for them? What should they be looking out for? What should they consider in ways in which they can save via tax incentives available to small business owners?
Thank you for that question. What I'll say is that it has to have, it starts with the background. And that is, for those that have businesses, if you are running obviously, if your business is making losses are not taxed, so you don't pay taxes on losses. But when you get to a point where you're beginning to make that profit and taxes is becoming an issue, the first thing you want to identify is to understand that tax planning is different from tax compliance. So that's when you have to now begin to look into tax planning strategies, because tax compliance is just like you're reporting what you've done, what happened in the year. So tax prep is compliant. It's not going to save you on taxes. But when we move to the realm of tax planning, that is where business owners can really save on taxes. And I'm going to go over a couple of things that they can do. The first is to understand that the easiest way to save on taxes is to maximize your deduction, maximize your expenses. And how do you do that? You do that by ensuring that you have accurate set of books, like doing your bookkeeping correctly. Without accurate set of books, you might be overpaying in taxes. You might be overstating your expenses or understating your expenses or overstating your income, as the case may be, and that would negatively impact your taxes. So your bookkeeping must be done right to actually know, to have an idea of how much you are expected you owe, or how much profit you make that will be taxed. So that's the first thing. That's actually the foundation, right? So once you have those good set of books, then the next thing is, what strategies can you implement? Some of the things I tell my clients is that, number one, you have to be looking at, for those that are solo entrepreneurs that don't have employees, you have to be looking at retirement savings. A lot of solo entrepreneurs don't save. A lot of business owners don't save for retirement. That's what we've seen. And so, but there are strategies, there are a lot of avenues for you to do that. We have the solo 401k, which allows you to put away money, tax-free money into the future, not tax-exempt money, a way that you can use to save on taxes. You don't pay taxes on that money. And for 2023, you can, for solo 401k, you can actually put as much as over $60,000. I can't remember the actual amount, but that's an avenue for you. Solo 401k contribution, SEP IRA contribution, and those are retirement drivers that you can save on. And secondly is also, you can also save using your business by utilizing your business to, number one, if you have employees that you've employed in the business, those are tax deductions that you can write off on your business. Then your mileage is another very important thing. You could have a car that you're currently using for your business. You can take mileage car deductions. If you are an individual that does Uber, that drives a lot in your business, tracking your mileage and taking car deduction is very, very good for you. You can use that to maximize your deductions. And then also looking forward towards credit. There are a lot of credits that are available out there as well. It's not just about expenses or deductions. Look into credits that are available for you. In the last year, we had the ERC credits, which is a COVID-based credit for those that have employees. A lot of people took advantage of that. Those that were eligible for that, they also took advantage of that. It's also looking at credits that you can qualify for. So credits and deductions. And so aside from the credits, now when we go to the deduction part, one thing you also have to understand is that when you're all of these things have limitation. Most of the credits that you get, or even deductions, particularly for the retirement the contributions as well, they have limitations. So when your income is above a certain level of income, you might not be able to make those contributions and make them taxable again. You might look into Roth IRA avenues as well. Roth IRA is a very good one for those that are ready to pay taxes now and prefer not to pay taxes in the future. They can contribute into Roth IRAs as well. For those that have businesses that are in certain industries, like the healthcare, like businesses that usually gives grants. For those in the healthcare sector, there are a lot of grants, statewide grants, and even grants from individuals, from companies and corporations. You can also look at maximizing grants, where you're getting grants from these organizations to utilize in your business. Just be aware that grants are often taxable. And so when you get grants, you're also going to pay taxes on that. But overall, I would say in summary is to make sure that you are keeping accurate records of your transactions, identifying expenses that are business expenses, and you're keeping the receipts and the documentation and invoices to corroborate those expenses on your tax return, and then maximizing your credit as well, whether it's employer-based credit or any other credits available for your industry within your state or at the federal level.
Thank you very much, Mrs. Agbaje, for that succinct delve into savings for small business owners. Now we have some questions in the chat box directed at our panelists, and I'm going to be taking them. And once I done with that, we'll then open it up to our members, our participants, to ask questions directed at the panelists. The first question here says, how can charitable contributions be used as a tax saving strategy? How can we use charitable contributions as tax saving strategy? And I would like us to answer in these two ways. One person look at charitable contributions as me as an individual being, given to the charity of my choice, and to people who own charitable organizations or groups who fall under charitable, classifications under the corporate, the commercial law, so that's two aspects: as an individual and as somebody who owns or who is a member of a charitable organization. Thank you. Mr. Agbaje, I think you would go first, and then maybe Mr. Babalola, and then Mr. Mondale would then, finish up.
Yes. So for individuals, like Mr. Babalola mentioned earlier on, if you're itemizing, you get to take contribution deductions on your tax return. And so there are several ways by which you can contribute. Oftentimes people think it's just cash. It's not. So you can contribute cash. You can also contribute items to goods and items to organizations like Goodwill or any other organization that takes those things. Just be aware that there is a limitation. For cash donation, you can contribute up to a maximum of 60% of your adjusted gross income in a year. And for donation of items, of goods, of stuff that you're taking to Goodwill or any of those organizations, you can contribute a maximum of 30% of your adjusted gross income. But yes, you can contribute that. What I tell people, for some of our clients that we do tax planning for, towards the end of the year, what we tell them is to look at things around their houses or around their properties, whatever they have, that they are not using, that they can easily just take it over to those places so that they can get some tax write-off during the year, assuming they are itemizing. So you have to be itemizing to be able to take those advantage of those things. Another avenue, particularly for high income earners, is to look at options of either having a foundation themselves, we see things like the Bill Gates Foundation, all of those foundations, they are owned by individuals. And so most high income earners have foundations. Those foundations, they are not just contributing just for the sake of contributing. They are using those foundations and those givings to really help them save on taxes as well. There's a lot of incentives when you give in the federal tax code for donation, and so they're using those avenues as well. So that's that. Now, on the part of the entities that are receiving those funds, oftentimes donations are made to non-governmental, to tax-exempt organizations, meaning they are not really for profit. So essentially, most often than not, if they are not involved in, there's something we call the PPIT, I've forgotten what that is, but if the activity is restricted to the courses that they are doing, technically they wouldn't have a taxable a profit to the extent that they will owe taxes. but they still are required to prepare the 990. There is a filing requirement for all of those organizations. There's a 990 easy that they need to file, depending on the size of their business, of their organization. There's also the 990 long form where they need to file as well. So there's a filing requirement for them, and they could also be taxed if they are involved in any activity that does not relate to their course. So if they are involved in any business-related activity that is different from the cause that they were created for, they are also going to be subject to an extra tax on that. But overall, the individuals take the benefit most, not the organization themselves, right? So I'll give it to Mr. Paloma.
Thank you so much, Mr. Gbade. I just want to put it out there that the Nigerian Professional Group is a non-profit organization registered under 501. And I know that this question is even more important to our founders who have, created this forum for us, for the rest of us to be able to benefit from. Mr. Babala, would you want to add anything to that?
Yeah, not really. I think she has, covered the basis there. She mentioned basically everything on both parts. The only addition that I may just want to point out as well is, you have an option of donating your vehicles. Maybe you have very old vehicles that you're not using, instead of junking it or, giving it out for free or trading it in at a lower value, you could actually get a big tax savings from it by donating it to Good Samaritan or anything like that, because those are listed assets that that you can deduct from your income. So that's just the only thing I can add to it. She mentioned mostly other areas. Thank you.
Thank you so much, Mr. Babala. I have this question, and I would like Mr. Mondal and Mr. Bala to weigh in on this question. So one of our members here did ask a question to say, please, in a case where there is an error with an already filed tax, are there penalties? Part B, also, how can one make a correction? And would there be any fee with respect to making corrections? Thank you.
Should I go first?
Yeah, I can. Okay, go ahead.
Oh, yeah.
You want me to go ahead? Okay. All right. Yes, I believe that if you have error in your taxes and you got a notice from the IRS, you have two things to do. One is make sure you reach out to a tax professional to guide you how you're going to respond to those notices. Because sometimes the notices might say, we don't want you to do any amendment. All we want you to do is provide the document and pay the fees, But that's not really the only way. You just don't have, if you get those messages and you are at fault and you missed a document, the best thing to do is to reach out to them and send the document that they requested, and after having reached out to a tax professional. The other thing you could do, if they didn't say you cannot do an amendment and you know that you missed a document, you can do an amendment and send those amendments in immediately so that they can now review that and make any adjustment that you have. And I can tell you this, firstly, on the individual part, right? If you are an individual, you get a notice. Those are the things that you need to do, and make sure you are not putting it aside. Don't try to hide it. Don't try to neglect it. You just need to take action and refer back to them and always get in contact with them. As long as you are getting in contact with them, you will be okay at the end of the day. And that will reduce you from paying more interest, more fees. And if at the end of the day you are at fault and you need to pay the money back, and you don't have the money, you can go on payment plan with them, and they can go as low as you can to be able to pay it over time. So the important thing is never to put it aside as if it does not exist. Always go back and talk to them, reach out to them, to the IRS, because a lot of people think IRS are some monster somewhere that they cannot talk to. I think you can talk to them and they will be able to answer you. The other part is if you are a business owner and you get notices like that, it usually, maybe if it's your first notice, and they say maybe you file late or you missed something, you can go back to them. I've done a lot of businesses that I went back to the IRS on behalf of the businesses, and they waive off the penalty because it's their first time, But if it's been many times, then they may not want to waive it. The only thing they're not going to waive is the interest if you have to pay money back, but they can waive the penalty as long as you can talk to them. So in any case, you don't want to put it aside. You want to face it. You want to seek help. You want to talk to a tax professional that can help you, not just anyone. And I think it can be solved. You don't need to get anxious or run away from IRS.
Thank you so much, Mr. Balola. Mr. Mondale,
Yeah.
do you have anything more to say?
Exactly. Just as he mentioned, the last thing you want to do is ignore it. So a lot of times when they send you a notice, it's just because they want clarification. So it's not a bad thing. You want to keep an open line of communication, and then you want to be able to respond with the information that's needed. And also, one big thing to keep in mind for business owners, a lot of time it's important to make estimate payments, because when you're an employee, they take the taxes from your paycheck. But when you are a business owner, you either have to pay at the end of the year when you file, or sometimes to help yourself from having to pay a large amount, it's helpful to make quality payments. So the IRS and have a schedule as to when payments are made. They usually happen on each quarter, and in that way, it's going to help you alleviate your tax burden when it's time to file your taxes.
Thank you so much for that, Mr. Mondale. We have one more question here that I would like to ask again. This question says, from Olaumi, says, is there a standard list of categories for tax credits? Is there a standard list of categories for tax credit? Mr. Babalola, do you want to go first? Okay.
Yes, I can take that. Yeah, there's a list. Usually I will point you to IRS website. That is where you can get all the lists. If you IRS website and you just click on the individual, it's gonna list out all the credit you could take for individual as well as for businesses. And businesses are different. There are different type of business. There is the single owner LLC, there are S corps, there are partnership, corp, all those, they listed out every type of credit that you could take, even the deduction too, they list them out, and they explain how to get them, and they even have like a scenarios where you can put in your data and it will tell you if you qualify or not. All that is online in the IRS website. And I know that if you go to Google, you may type something in and try to find answer, you get the different opinion. But I would tell you that the best place to go is IRS website, because you have all your information right there.
Thank you so much, Mr. Babalola, for that update to that on how to get that. So we're going to open up now to members. If anybody has questions, this is the time for you to use the reaction button by raising up your hand so that we can direct the questions to our speaker. And I'm going to go first with Mr. Igbinewe. I apologize if I'm not pronouncing that right. Igbinewe, please kindly unmute your mic. If you're able to, of course, let us see your face. If not, just go ahead, unmute your mic and ask your question.
Hi, everyone. Thank you, Aaron, and thank you, Tayo, and everyone that has, really just been giving free knowledge to us today. And we appreciate you. My question is quick. If you have a business, a small business that you just started, and you haven't made a lot of money, say you made only about 10,000, so obviously it's not a lot. Would you be filing, and you have an LLC, would you be filing tax as just an individual, or is it better to file separate, file one for the business and one for your personal returns?
Can I take that?
Yes, please.
Okay. Yeah. Yes. So if you have a business and you've made $10,000 on that business, the way you file your taxes, is dependent upon your entity type. So if you are an LLC, single-owned LLC, you will still need to report that income. As a matter of fact, every income must be reported. So regardless of whether you have expenses against it or not, or the income limit, you still have to file it. Now, how you file that or report that income is dependent upon your entity structure. So let's say you are a single member LLC, you are going to use Schedule C to report your income from that business, and that is on your 1040. So it is not a separate tax return, it's just an extra schedule that goes on your 1040 where you're going to report the income from that expense, from that business. Now, before you conclude on that, you have to understand that, like I mentioned earlier on, there are expenses that you could deduct, right? Look at that income that you've made. What expenses can you deduct from that income? Did you work from home? Do you have an exclusive office in your home? Could you take the home office deduction? Did you drive to clients' places? Did you drive? And now, when I mean driving, commuting miles doesn't count. It has to be you driving to, to clients' places. It has to be you doing drives that are business-related drives. Could you take mileage deduction, expense deduction, utilities, and all of that stuff? So you don't want to just report the 10,000 because the old amount will be taxed. So look at the expenses that you can deduct to offset part of that income legitimately, so that you can bring that down to a taxable amount that is a lot lesser and will reduce the tax burden on you.
Thank you very much, Tayo.
Yeah, welcome.
Thank you. Now we're going to have Oluremi Faturoti. Can you please kindly unmute your microphone? If you can also show us your face, and then go ahead and ask your question.
Hi, everyone. Sorry, can you hear me?
Yeah.
Oh, okay. Yeah. Thank you so much for having this forum to get us through stuff. I just have a quick clarification or question to make. And so regarding the pass-through entities, I think Mr. Bade answered this last question. So my question is just to clarify, because I see when they talk about pass-through entities, LLC, partnership, depending on the type of LLC, if it's single or partnership and stuff, like you have to file by March 15. But for sole LLC, so like a sole proprietor, right, that has an LLC, you have to file your taxes on your Schedule C when you're filing your personal income taxes, right? Does that March 15 deadline apply to such, or it's fine to still get on your Schedule C with your 1040 by April 15? That is actually the timing deadline for personal income taxes.
Yeah,
Mrs. Agbaje, yeah, I was about to call on you.
Okay, so the deadline still goes with April 15. So it goes on the deadline for the individual taxes.
Oh, okay. So that's fine. So what's the pass-through entities when they talk about partnership and the fact that you have to file by March 15? What does that speak to? What's that for? Is that for those that would be getting K1s or what?
Yes. So the March 15 deadline is for S corps and partnerships that are pass-through entities. Both entities are pass-through entities. The deadline is March 15. You can extend. You have a 6-month extension till September 15. If it falls on a weekend, it's going to be the next working day. But that is the deadline for that. Now, most of the times, because they are pass-through entities, those business structures don't pay taxes at the federal level, at the entity level. So the income and expenses flows through to the individual partners and shareholders through the K1. So you will be getting a K1 from those entities, and you're going to use that K1 to prepare your personal tax return. Now, you also have to know that though at the federal level, those entities do not pay taxes at the entity level, but state taxes might still apply. There are states that still tax entities, S corp, partnership at the state level, at the entity level, where when you complete that tax return, you're going to see a tax due to the state. So that's something to to kind of keep in mind. But essentially, the deadline is March 15, and you'll be getting a K1 to prepare your personal tax return.
Thank you so
Okay.
much, Mrs.
That's
Zabaje.
all.
Thank you. Thank you, everyone. Thank you to our speakers, our panelists. Thank you to everyone who dialed into the call. And just before we round up today's session, I'm going to call on Tony to come up for the closing remarks and, speak to us just before we round off. And a big thank you again to everyone. Tony, please, can we have you come up? Tony, we can't hear you. I think you're on mute.
Oh, sorry, I was on mute. Thank you, Ayodele. That was a good moderating. Firstly, I'd like to appreciate our keynote speaker, Mr. Aaron Mundell. He tried as much as possible to emphasize to us the benefits of EV vehicles and solar panels for our homes and all the rest of them, that we have enormous tax credit to claim, from the federal level, at the state level, and also depending on the companies that provide these services. I mean, the adverts are all over the place and all the rest of them. And it also try to enlighten us that, well, because of those tax credit that we gain, if we take advantage of it now, on the long run, we'll be better off for it. And would like to appreciate you for that. And of course, we can still reach out to him if we have more questions. I'm sure, we can get to know them through our platform, and that will be possible. Also, would like to appreciate Mr. Wole Babalola. Thank you very much, sir, for all the insights that you've given us in terms of the standard deductions and the itemized deductions that we can take advantage of in our various taxing. Well, if we didn't do anything this year, we have the opportunity, It's never late to be right. So if this year is the year that we are going to do it right and start getting those deductions from our taxes, it's not too late. We can start it now. We are grateful. Thank you for your time, and thank you for the insight. Also, I'd like to appreciate Mrs. Taiwo Agbaje. Thank you very much for the enlightenment on estate planning and when to pass on our bequests, to our beneficiaries That is useful. We did that, after passage. But the most important thing is to have that documentation. My dad died intestate. Intestate means that he died without a will, and we were in probate in Nigeria for almost 20 years. We couldn't get our letters of administration, for that long. And it was really a bitter battle. He died in an accident, and all that. So it's good to have a will. And for the estates, it will only distribute your property, okay? For the estates, it puts everything under one umbrella and is being administered by a set of trustees. And those children or those named beneficiaries can be the trustees in that estate as well. So you have it just evolving. So I like us to take advantage of that, meet the expert. Don't say until I have everything. We can never have everything, okay? But the one thing that you have, you can start with that. This program was organized or is organized by NPG. NPG is Nigerian Professional Group. I'd like to invite us, as many who are on this call this afternoon who are not part of us. We have lots and lots of things. Earlier on, we had the Black History Month, and we talked about, mental health and various, issues around that. It was an awesome time. If you go to our website, you'll see a lot of all this information there. You can follow us on our various social media handle, particularly LinkedIn. We have opportunities, for job, for employment for those of us who are students doing a postgraduate or undergraduate or PhDs, information on change of status. We have various gala events. We have that, events that we do during the year. And at the end of the year, we have an award event where we appreciate entrepreneurs, both in America and, outside America, diasporians, from African descent who are well established and have done well in their various fields. All right. So lots of things to take advantage of, networking, information. I hear it all the time. America is all about information. It's a land of opportunities. And, having information is not enough. It's what you do with that information that gives value to it. And you can get that value at the Nigerian Professional Group. So I enjoin you, if you have not joined us, please try to go to our website, join us, we'll welcome you. And, you'll be glad you did. Once again, thank you everyone for making our time. We've been here for 1 hour, 17 minutes or thereabouts. We really appreciate it. We thank you very, very much. And we look forward to seeing you at our next event when we call upon you. Thank you and God bless.
Thank you, everyone. Thank you, our speakers. Thank you, participants.
Thank you.